Hi everyone, welcome to our October 2012 newsletter. We purposely delayed getting the newsletter out this month until after the election since that was such a significant event. We'll talk about that in depth, but first I'll recap what went on in October. Looking at the chart for the S&P 500 for the month, we see that we had a couple of attempts to push the market higher, but finished near the lows at the end of the month. The S&P was down 1.8%, the Dow was off a little more than 2.4%, but the International was up 0.8%, which is where we had about 2/3 of our equity allocation deployed. Most of the latter part of the month reflected the disappointment with some earnings reports. Actually, the earnings were better than expected, but the guidance or future outlook from the companies concerned the markets that a slowdown is ahead. The major economic indicators in Europe were relatively quiet, so more attention was placed on the earnings. Just another example how difficult it is to predict how the market will react. Good earnings numbers and the market still sold off. As for the election, what an ugly process we've created in our political system. From the amount of spending on advertising to the unpopular electoral college to the extreme partisan bickering, it was a painful thing to witness. It seems like nobody won without getting their nose a little bloodied. So how will this affect us going forward? We've already seen a sharp sell-off since the election. Since November 1st, the market's down 3%. But let's go back and look at the market activity surrounding the last presidential election. From October 27th to November 17th in 2008, the market dropped 17%, so we are far better off this time around. Of course, there were other issues contributing to the market drop, not just the result of the election at that time. As you can see, the market bottomed out on March 2nd, 2009, which was a total decline of 27% from October 27th, just 5 months earlier. From that point, the market climbed 115% to its peak on September 10th of this year. Of course, that peak was still lower than the all-time peak of 1,526 in July of 2007. Over the last 4 years, the economy has struggled to head slowly, almost as in slow motion. I would predict the same for the next 4 years if it weren't for the fiscal cliff facing us in January, as the government will be forced to raise taxes or cut spending, or both. If you'll remember the last time the government was forced to address this issue, that was in October 2011, and they didn't deal with it then, and that's why we've gotten to where we are now. It's hard to forecast a solution for this problem that doesn't carry painful side effects. So we're taking protection in the portfolios and reducing the equity holdings down to only one. If the market sells off further from this point, we'll wait patiently for an opportunity to get back in. If it somehow finds positive in what it sees and starts back up, we'll respond as quickly as we can to capture any sustained run up. Right now I'm more concerned with what we could lose than I am with what we might miss out on gaining. Also this month we're including a couple links to articles that I've been quoted in recently. Please let us know what you think. That's it for this month. Thanks for listening. As always, please share this video with friends or family. I'll talk to you next month.